Do you have a system for when you decide like enough people have flowed on, or?
I don't. I wait until we're supposed to start, which is 2, and then I wait a little bit longer until the derivative is getting close to 0. Now, I always say this, but when we first started doing this, people would log on like 10 minutes early because no one knew exactly what was happening. But now that everybody's like a Zoom pro, everybody logs in like 2 or 3 minutes late, just like you would do in a real seminar, show up just a tiny bit late, and everything just, except at the Minnesota Fed, start on time, end on time. They rule that place with an iron fist. I liked that. Yeah, so we're going to get going in about a minute here. Here's the link to the slides is in the chat room. And so welcome everybody. For those of you who are new, house rules are, we just with questions, just unmute yourself and break in. There's no need to raise your hand or do anything like that. Doireann, do you have any co-authors in the chat room today? Is David here? Or?
I believe so. I can't see the list right now, but
all right, look.
I see Anthony.
Oh, Anthony's here. Okay, good. Yeah. Oh yeah, I see Anthony too. Okay, yeah,
maybe,
great. So let's see, Sarah, QR.
Sarah, maybe.
I don't see Sarah.
Oh, we've got one, so that's.
Well, we've got one. That's enough.
Still
so
right?
Yeah. So if you'd like to ask other questions, if you'd like to ask questions in the chat room as well, if you don't want to break in or you think it's more of an aside, then Anthony can address them. As well. At the end of the talk, we'll have at least 10 or 15 minutes to just leave the line open, and we can continue to talk and make comments there. So, okay. So I think without further ado, Doireann, take us away.
Okay, thanks, Kim and George. So this is joined with David Argente, Sara Moreira, and Anthony Priolo. We got to put up our 2 disclaimers for the Federal Reserve and for Nielsen. Okay, so what is this paper about? Well, obviously we're about, how do firms build market share? But in terms of motivation, as economists, we think it's interesting that firms are born small, they grow and they die. And we want to know what explains this process. So in this paper, we dig into an explanation that's based on demand. And so more precisely, we have an empirical part to the paper, and then we have a quantitative part to the paper. So in the empirical part, we use retail scanner and advertising data, so a combination of these two, on consumer food to show that entering firms, in this case in the consumer food sector, though I'll talk a bit about external validity, that entering firms grow, first of all, by adding new geographical markets, which, doesn't come as a surprise to anybody with a background in international trade, but this is going to be within the US. They grow then within a market by building market share in sort of within geographical markets. And they do this without changing their markups. Then third, we show that entering firms use advertising as a means to generate sales within markets. That may not be the only means they use to generate sales, but they're not playing around with markups, and we show evidence that they are using advertising. So that's the empirical part of the paper. Then the quantitative part of the paper, we use these facts together with a structural model of market entry and customer acquisition, so a dynamic structural model, to back out what is the distribution of intrinsic heterogeneity across firms. And then we use that together with the structure of the model to show that the variance in firm size on entry is 6 times the variance of this intrinsic heterogeneity, showing that demand frictions magnify cross-firm differences. And then, one of the things we want to do with this model, but we haven't done yet, is to use it to show what is the contribution of endogenous demand to firm growth. So without further ado, let me jump into telling you about the data, which is necessary to sort of explain the 3 facts that we're going to be focusing on in the empirical part. So we have 2 main data sources that we work with. So the first is Nielsen retail scanner data, which we have for a period of 12 years. These data, I mean, there's been an explosion of papers that make use of Nielsen data in one form or another. This is the retail scanner data, where stores that are monitored by Nielsen report weekly data on total sales value and volume at the store UPC level to Nielsen. So that's the data that we get. So this is collected at the store level, not by looking at individual consumers. Aside from the value and volume at the store UPC level, we also know what is the product. So Nielsen has a categorization of product modules. We know what is the brand. We know the location of the store, and we know what chain it's attached to. Then we use another data source called GS1 to match UPCs to firms. So that's going to allow us to sort of aggregate up and talk about firms. Nielsen, monitors a variety of different stores, grocery stores. 50% of grocery sales in the US are monitored by Nielsen. It also monitors sort of big box retailers like Target. It monitors drugstores. We're going to focus on food for the reason that we want to look at a set of products for which markets are geographically segmented. And we think that, throughout this sample period, it's reasonable to think that, although, online retail has become increasingly important, that, people are buying food in their local market, and the prices they pay for food are the prices that are charged by retailers in their local market. So that's the first set of data, which a number of people have used. The second set of data has been somewhat less used in the literature, and that is Nielsen data on advertising. So we have 8 years of this data, which is called Ad Intel. So Nielsen monitors a bunch of different media, sort of in terms of advertising media, TV, newspapers, outdoor, big banners outdoors, magazines, radio, sort of a variety of different media. In order to use these data, we construct a crosswalk at the product and the brand level to match with the scanner data. And then we focus on local TV advertising, which is sort of the medium that Nielsen, it's sort of its headline product, and that it monitors best. In the sense that it's monitoring throughout the US, not just in a subset of regional markets. And we're able to sort of link the advertising to the particular local market. Okay, so is food advertised on TV? Well, 6% of the brand products in the scanner data advertise on local TV. That seems a pretty small number, but that accounts for about 45% of the total value in the scanner data. So local TV is a medium that food products use to advertise. This is not sort of all the advertising that is done by these food manufacturers. And we're going to treat it as such. This is not a sort of a census of advertising. It's just giving us some window into the advertising behavior of these manufacturers at a geographical level, where we can match, sales with advertising. We also use some other data sets, the Nielsen Household Panel, IRI, which is a bit like Nielsen, and we make use of other media and ad intel in robustness checks. Okay, so before we can use this data, we have a bit of terminology to get out of the way. So we're going to talk about products. What is a product? Nielsen has 603 distinct food product modules. So one example is yogurt. And when we talk about products, that's what we're going to be talking about. That's the level at which we think we can make comparisons across different brands in terms of, prices and quantities. So sort of ounces of yogurt are comparable. Ounces of yogurt are not directly comparable with ounces of mozzarella cheese, which is another product module. What is a brand? We're also going to be talking about brands. Brands are Nielsen-defined aggregates of UPCs. The brand is sort of usually the level at which advertising happens. And there are more than 50,000 distinct brands in the retail scanner data. So some examples of brands here in the yogurt category are Yoplait, Chobani, and Danone. So these are, when we talk about brands, that's sort of an example of what we're talking about. And then what is a firm? A firm is a collection of products and brands. And there are more than 20,000 distinct firms in these 12 years of the retail scanner data. And some examples, General Mills owns the Yoplait brand as well as other brands. Chobani owns the Chobani brand, and Danone owns the Danone yogurt brand. So
what about like store brands? How are those handled in this data?
Okay, so maybe I think we may be including them at some point. We dropped them, and then maybe we may be including these again. We're going to be focusing on entrants, so it's going to be important to us, that we are doing that right. I think we may be including them in this version, but I know that in older versions we didn't include them and we found very similar results.
Okay, so you do have data on them, whether or not you're using them, it doesn't seem to make a difference. Okay.
Yes. Okay, so then what is a market? So we know sort of what zip code a store is located in, but we're not going to work with zip codes or counties or commuting zones as the level of geographical aggregation, because we're going to be interested in this mapping between sales and advertising. And advertising is monitored at the level of a Nielsen DMA. So there are 210 DMAs or media markets in the US that are monitored by Nielsen. And when we talk about markets, these media markets are the markets we're going to be talking about. I mean, if you're just looking at the map, it seems reasonable enough to think that these markets are likely segmented from a consumer perspective. So although they're not the sort of the standard counties or commuting zones, these seem sort of a reasonable level of aggregation to be working with. Next definition, what is an entrant? Okay, so our interest here is going to be on, firms that are born and what happens to them after they are born. We're going to define an entrant as a firm that has sales in a given calendar year. So let's say, for example, 2008, but not in the preceding calendar year. So not in 2007. We're also going to be interested in, use information on entry at the level of sort of firms and markets. And again, we're going to use a corresponding definition there. If we see you in a given year selling something in a market and we didn't see you selling in that market in the previous year, we're going to consider you an entrant.
So Doireann, is that across products or per product?
So you'll see mostly we're going to be talking about the level of the product. So first of all, I'm going to show you some facts about firms. So I'm going to talk about firm entry, where I'm actually going to condition on the products and the brands that a firm has in the year that it started selling anywhere in the US, and follow those over time. And then we're going to do analysis at the level of the brand, the product, and the market, where it's going to be entry at that level. So our entry...
Rock here.
Yes?
It's fair to say the paper is about the role of advertising. I feel to me that the geographic area, definition of products, it's mostly with advertising in mind, right? There may be other ways that a firm builds market share, but advertising, surely it's important. But is it right to say that the design of the exercise is mostly with advertising in mind?
So we're setting up our exercise knowing that advertising is the important thing. I mean, maybe it would be helpful if I could describe what we need from the data and then show you the facts, and then we can argue about what's important about what we found.
Well, I mean, for example, something like food, those definitions of markets are like way, way too large from the point of view of an individual consumer.
Sure.
Nobody really goes too far.
Sure,
to shop for a yogurt, but the TV makes sense.
That's fine. That's not a problem. What matters to me is that they're segmented from the perspective of consumers. Maybe they're too big, but they're not too small. So
They're
that's
certainly not too small for food, but from the point of view of the demand, they are too large.
well. How about we actually show you the facts before you decide that you have a problem with what we found? I haven't got to the facts yet.
I have no
So-
problem what you found. I don't know yet what you have found.
Exactly. Let's get there. So is entry important? So you can see here in terms of the yearly average, in terms of the cross section, 12,000 firms in an average cross section, of whom 1,000 are firms that didn't sell in the previous year. So it's kind of like 8% of the firms are entrants. These entry rates go up when you think about more disaggregated levels. So entry is a big deal.
So Doireann, just to repeat my question, entrant here means the firm sold no product and no market the year
Exactly.
before. Okay.
Okay, so this is the last slide that is terminology, and then we'll actually get to the facts. Okay, so I'm going to use this terminology extensively to sort of tell you about how we see the data, or to extract some things that we think are interesting and informative. So this table shows you just a hypothetical example. Suppose we had data for 2006 through 2013 on, let's call these firms A through H. And let X be an observation where I actually see that a firm sells something somewhere in the US in that year. So we're going to refer to a spell as a continuous episode of sales. So continuous in the sense that we aggregate up to an annual level, and do you sell in all of the sort of years in a continuous way, then we're going to call that a spell. So for example, I highlighted in blue, for firm A, we have a spell. That spell is left censored and right censored. So we don't know when it started and we don't know when it ends, because we see it both in the first year and the last year of the sample, but that's nevertheless a spell. For firm E, we see two spells. The first spell is 2007 only, and the second lasts for 2 years, beginning in 2009. We're going to focus our analysis on first spells. We're not going to look at the re-entry spells. Second piece of terminology, duration. So duration is going to be the length of a completed spell. So think about firm C. Firm C, this particular spell lasts for 5 years. So the duration of this spell is 5 years. Now, if we don't know when you exited, we don't know the duration of your spell. So firm F has a spell, we don't know, it lasts at least 5 years, but we don't know how long it lasts. We don't know its duration. We're going to be able to use information in these right-censored spells, or information on duration in these right-censored spells, by top coding. So we know that this spell for firm F lasts at least 5 years. So we can say something about stuff that happens up to durations of 5 years. Tenure is how we're going to refer to the current age of a spell. So I have here in this light blue highlight, these are 2 years. So for firm B and for firm D, these are a tenure of 3 in their respective spells. So firm D, it's a spell that has duration of 3 years. In 2009, the sort of tenure, the age of that spell is 3 years. Firm B, again, we have a right censored duration, but we know that the tenure is equal to 3 in 2009 because we observe entry within the data. So those are all sort of pieces of terminology that we're going to use. Okay. So now with that, I'm going to jump into the actual facts. Sorry, wrong direction. So we want to show you 3 facts. So the first is that entering firms grow by adding new geographical markets. So let me give you an example here. So for argument's sake, let's call this firm Chobani. So this is a firm that starts selling in 2007 in the New York media market. In 2008, it expands on the Eastern Seaboard and a little bit in the sort of Midwest. In 2009, it expands, fills in the Eastern Seaboard and the Midwest, expands to the West Coast as well. By 2010, it's selling in most media markets in the US. And 2011 and 2012, it's selling everywhere except the top right corner of Maine. And in 2013, I'm not showing you, it sells everywhere in the US. So this is an example of a very successful firm that entered in one market and then rolled out to gradually to sell in all the markets in the US. So how are we going to sort of collect information on episodes like this? We're going to do this as follows. So we're going to, for each firm that enters in the sample where we observe entry, we're going to regress the log of the number of markets that the firm has in a given year. I like to think about these regressions as take the exponential and then I can bring fixed effects under on the left-hand side and think about how I'm doing some normalization. So we normalize the number of markets by the year that we're talking about. Maybe all firms sell in more markets in some years than in other years. We're going to normalize by the year of entry, the cohort for this particular firm. Maybe firms that enter in certain years are just always selling more markets than firms that enter in other years. And then we're going to, once we've taken out those normalizations, we're going to regress the log number of markets on a non-parametric set of indicators for duration and tenure that are interacted with each other. Okay, so that's why I told you about the definition of duration, which is the length of a completed spell, and tenure in the past couple of slides. So it allows us, yes.
Sorry, George. So you guys are making a decision on like the unit interval as being a year.
Yes.
That obviously has some, effects on how you think about measuring these things. Could you do this with like more high frequency data and have like a better estimate of what's going on and how much of the variation is due to like heterogeneity and participation within a year?
We certainly could. So we have done some analysis at the quarterly level. Right now, we're going to use the year as the baseline. This is pretty big data. So once you sort of increase the frequency, it becomes just everything takes longer to run. But
no, I can appreciate that.
Yeah.
I think it just sort of speaks to like how guys enter the market, right? And when they might have the signal to leave the market or something like that.
Right. So we can definitely look at, and I can show you some things that we did at the quarterly level later on.
No problem. I just wanted to, yeah.
Yeah,
Thanks.
we worked with the annual. So on the sort of, okay, so we run this regression, we estimate this coefficients of interest are this vector beta on these indicators for duration and tenure. And then think about taking the exponential of those betas. Then we're going to show you the following picture where on the x-axis we have tenure, so the number of years that the sort of age of a firm. And on the y-axis, we're going to have the number of markets where we normalize the number of markets to be equal to 1 for firms whose spells last at least, whose duration is at least 5 years. Okay, so then this beta, this rich set of indicators, allows us to show you how the number of markets is related to duration. The number of markets on entry is related to duration, and you can see that firms that last longer start more markets. And then we can also see how the number of markets evolves with age, with tenure, for firms, say, that last at least 5 years. And there we can see that between year 1 and year 4, the number of markets increases by 50%. So growth in markets for successful firms, for firms that survive, is an important component of growth, is adding more markets. Okay, that's sort of in summary the first fact. The second fact that we want to show you is that firms also grow by building market share in continuing markets, and they do so without changing their markups. So
Hey, Doireann,
Yes.
Sorry, just not to interrupt you, but if you go back to that previous result, is there any way of kind of comparing that to what people find in the open economy?
So I personally
Faster or slower? Or
have run the same regressions for exporters.
I suspect you have.
I can't remember.
Gotcha. Okay.
I can't
It would just be
remember.
nice to know how like easier to kind of expand geographically, domestically versus foreign.
I can totally look at that. The pictures qualitatively look the same. In
Yep.
terms of the magnitudes, I don't remember.
Okay. Thanks.
So yeah, and that gets to a point which is important, which is should not be surprising to anybody coming from the trade literature that firms grow by adding geographical markets. This happens, but this happens within the US as well. And food is a sort of sector, because the markets are segmented from the consumer perspective, where we can see that. So, you know, they're by adding geographical markets, they're selling to consumers they did not sell to before. Whereas, of course, if we had, you know, products that people buy online, then we wouldn't be able to say that. But for these food products, we know that because they're moving into new geographical markets, that they're selling to consumers they were not selling to before. Okay, so now let's move to the second fact. So here I just want to pause and just describe some alternative potential theories of how firms might grow within a market. So one possibility is that, you know, firms enter a market, there's a demand curve, and they may slide down that demand curve by reducing their markups, and that way their market share grows. Another possibility is they may take actions that shift their demand. So change the demand conditional on the price. So one sort of semi-popular theory for how firms might do that is that firms may, you know, on entry to a market, they may charge a low markup to sort of persuade customers to try out their product. Then once customers have tried out their product, in some sense they're locked in, they may increase their markups and sort of squeeze the juices from those consumers. Another sort of way to frame that story is that, you know, I see somebody buys a product, I see that product that somebody else is consuming, and I say, oh, I should consume that product too, that looks great, and then I buy it. By charging lower initial prices, you may grab more initial consumers and therefore persuade more consumers eventually to try out your product. So that sort of is a story of shifting demand through prices because consumers buy products that they see other people consuming. Another potential story for how firms could shift demand is by engaging in non-price actions. So here I'm going to highlight advertising because that's something we have data on, but that's not the only non-price action that firms can take. They can also, you know, basically try to place their product in retail chains. That's something that is costly for firms to do. They need to, you know, there may be non-monetary costs in the sense that you've got to have your marketing people call their sort of team, or you may actually have to lay out outlays to sort of pay to get access to shelf space in a supermarket. Those are non-price actions. Those actions don't affect the sort of the price that the consumer eventually faces. So we're going to exploit the market dimension of our data to help distinguish between these theories. So how does that work? So we're going to use, in this case, rather than looking at firms, we're going to use brands and products. So why do we use brands? Because later that's going to match up to what we're going to talk about with advertising, and we're going to, you know, focus on comparing at the product level, because we can compare prices and quantities within products, but not across products. So at the brand, product, market year level, we construct prices. Well, these are real unit values. They're going to be the total value of sales divided by the total quantity sold. And then how are we going to use this cross-market dimension to distinguish between theories? Our identifying assumption here is that the marginal cost of production is the same for all markets within a brand product. So this is sort of like a definition here. So think about here, Chobani yogurt sold in New York, in the New York market. So we're going to assume that the cost of producing Chobani yogurt is the same no matter where it's sold. Now, there may be a manufacturing markup that Chobani charges a different markup to stores in New York compared to stores in Minneapolis. there may be a different transportation cost. We don't know where the Chobani is produced, but there may be a different transportation cost between that location and New York and that location in Minneapolis. And there may be sort of a retail margin, which, you know, the store composition in New York may differ from the store composition in Minneapolis. Maybe just, you know, it's more expensive to run a store and you need higher margins to operate in New York than you need to operate in Minneapolis. So we're going to be comparing across those sort of New York, Chobani in New York and Chobani yogurt in Minneapolis. And that's going to allow us to take out this marginal cost part under our identifying assumption. And what that's going to leave is variation in the combination of the manufacturer markup, the transportation cost, and the retail margin. And we're going to show you how that variation behaves. And we're going to argue based on how that variation behaves that it is unlikely that firms are mucking around with markups to shift their demand. Okay, so how do we do that? We're going to run 2 regressions using quantities and prices. So the quantity of Chobani yogurt in New York, we're going to regress that on Chobani yogurt year fixed effect. So again, think about taking the exponential and bringing this fixed effect under. We're taking out, you know, everything that's good about Chobani that's the same everywhere. We take that out. We also regress on a yogurt New York fixed effect. You know, how big is the yogurt market in New York? We take that out. And then we're going to regress on this vector of the same type of vector of indicators for duration and tenure interacted as in the case of the firms. We do the same for log prices. So again, here you can think that we're taking out, you know, the marginal cost by taking out a Chobani yogurt fixed effect, a Chobani yogurt year fixed effect. And then we're taking out, you know, something about retail margins by taking out New York yogurt fixed effect. And we're regressing again on the same set of indicators for duration and tenure. So now look at the bottom pictures. So on the left, we have the exponentiated beta coefficients for the quantity regression. So again, on the x-axis, we have tenure, and on the y-axis, we have quantity. So this again is all identified, think about Chobani yogurt, off of variation across markets within Chobani yogurt, having taken out the market size sort of effect. So we can see, first of all, there is some relationship, though potentially not super strong, between how much Chobani sells on entry into a market and how long it sticks around in that market. And then we also see that, you know, quantities, the quantities sold, or because we're taking out market size, the market share grows threefold between year 1 and year 4 in spells that last for at least 5 years. Okay, so we see big impacts on market share, big sort of quantitatively big impacts, or quantitatively big correlations of market share and tenure in a market. But if you look on the right-hand side, we see basically nothing when it comes to prices and tenure. So again, this is taking out the marginal cost part. What's left is this residual, which captures a combination of retailer markups, manufacturer markups, and transportation costs. And basically, there's nothing going on here.
Doireann, can I ask a question? So, sorry, it's Gideon. Here, I guess there are 2 sort of assumptions. One, the fact that the market product markup, they're the same for all brands, right? But I think perhaps there's the paper by Delavinia and Gensko showing that UPCs are uniformly priced across locations, right? And once this is the case, everything is going to be absorbed to the CT brand product fixed effect, if I'm correct here.
Okay, so just to say that that was about within chains. Okay, so that was not about these markets, that was about within chains. So uniform pricing within a chain.
Okay, but I'm trying to understand where is the variation to some extent coming. So if we believe within chains, the firm is setting the markup at the chain level, right? Mm-hmm. So then that's going to be absorbed here. I mean, I'm trying to understand what's the variation from which we're like can identify this, and then whether if we drop it, like we're going to see something different. I'm also asking this because in David's job market paper, we do see that prices tend to go up as the firm ages. It's a higher frequency one.
Okay, so again here, this is looking at variation in the price of Chobani across different markets. Maybe the price of Chobani changes over time in all markets. Maybe it goes up in all markets. That, you know, is going to be taken out by this Chobani yogurt year fixed effect. So this is saying, okay, market shares, you know, are evolving differently within the firm across different markets over time. But that variation is, you know, there's nothing going on with how they're pricing differently across these different markets. So here's a situation where we see big action in market shares across different markets within the same firm, but we see no action in prices. Okay, again, within a market here, this is these 210 markets. You know, they have different compositions of chains, so there's sort of a chain thing going on here, but that's you know, I'm in different chains in Europe than I am in Minneapolis. I don't see the same retail chains there. And that's going to be taken out by, you know, these fixed effects here.
Doireann, is it here we're not comparing early markets versus later markets? They're being pooled together here.
So here there are two sources of variation. So one source of variation is, again, comparing markets that I entered early with markets that I entered later. And the second source of variation is looking at within the same market over time. Now, I could take out the first source of variation by including, in addition, a cohort fixed effect, and we're running that. Okay. My prior is that's not going to change a whole lot. Why do I say that? Because I've run the same regressions for customs data, and that doesn't change a whole lot.
Okay, so I would have conjectured that when you go to a later market as a product, you expand faster there. But can I see that I'm wrong here, or that I'm right, or neither?
You can't see whether you're wrong or whether you're right. That's something that we can look at, but not from this regression.
Okay.
Yeah, we certainly could look at that, but yes, we don't see that from this.
Doireann, can
Yes.
I look at this and say that it seems more important the growth within a market rather than the addition of markets? Because with the addition of markets, you got like a 50%, and this looks like a 300% gain.
So I don't think you can back that out from this. There are other things that we can do which can decompose growth into the component that comes from adding more markets versus growing within a market. And we sort of have done that. The within market is sort of contributing to a bigger share, but there's a very important share which is coming from adding markets over time.
Okay.
Okay, so we have a bunch of different robustness on this. This is not an exhaustive thing. You know, just one thing that I want to draw your attention to, because it's going to be relevant when we talk about advertising. We do the same thing for the Nielsen household panel, and you know, we see the same pictures. The household panel also allows us to look at number of consumers and sales per consumer. So both margins are operative, but the number of consumers margin is quantitatively sort of accounting for more of the variation. Okay, so building market share in continuing markets, it looks like firms are doing this without mucking around with their markups. What are they doing to shift demand? There may be multiple actions that they may be taking. One action that we have data on uniquely, well, not uniquely, but you know, we're some of the first people to use combine the retail scanner with the advertising data is these data on advertising. So now I'm going to jump to the third fact. So first of all, let me sort of start by talking about local TV advertising at the firm level. So not at the sort of firm brand product market level. So let's categorize entering firms. Yes.
Sorry, just for the advertising, are you going to be able to separate whether it's like a complement or it's like an investment in advance? Like, so the idea would be you know, a lot of these consumer products, I would think you go and you try to convince a supermarket chain to take your product, right?
Mm-hmm.
And then part of the deal is then you have to start advertising, right? And so it's really the big investment is convincing Wegmans to carry, you know, what is that coffee shop near the Philadelphia Fed we used to go to that now has coffee, right? Like it's
La Colombe.
La Colombe, you know, and then you start advertising, right? So I'm just wondering if you can sort of sort that out in some way.
I mean, we think that these auctions are complementary. We could possibly do some more work to tease it out. I'm going to show you something that, you know, we think that you're entering stores and doing advertising simultaneously. These are two different kinds of non-price investments that you can take to acquire more customers.
Sure. Okay.
They complement each other. Here we ranked entrants by the number of years they eventually survive. And we look at the share of these entrants in these different bins that are advertising in their entry year. So you can see that, you know, the share that advertise on local TV is increasing in their eventual survival. So, you know, suggestive that there's something that the firm knows at the beginning. I mean, we don't think of this as causal. We think that there are good firms and bad firms. And the good firms have higher returns to advertising, and they're doing more of it from the very beginning. They're also advertising in more markets. And one other fact to know about advertising is that advertising is relatively persistent. So, you know, these are for these different bins, referring to these firms over the entire span of their years in the data. What is the total number of years that they're advertising? You see that it's not like they advertise one and done, that they're advertising in multiple years. Okay, so now we want to make use of the market dimension of this local TV advertising to show you some facts about the joint distribution of quantities, prices, and advertising. Okay, so we do this by estimating impulse responses of quantities and prices to advertising in a particular way. Just again, want to say that this is about characterizing the joint distribution. This is not a causal analysis. Okay, so we estimate these impulse responses by taking the quantity of Chobani yogurt sold. Just think about, let S be equal to 0. So let's think about the quantity of yogurt, Chobani yogurt, that sold in a particular year. Let's call it 2008. We're going to take out, so Chobani yogurt sold in New York. We're going to take out Chobani yogurt New York fixed effect. There's an average amount of yogurt that's sold in New York throughout the sample. We take that out using a fixed effect. And then we also take out the market size for yogurt in New York in the particular year. And then we regress that quantity on an indicator variable for advertising in 2008 by Chobani yogurt in New York. Okay. And we do that also for sales before advertising happens. So we let S be equal to -2 or -1, so 1 or 2 years before the advertising happens, and for 1 or 2 years after the advertising happens. We do the same for prices. Okay, so these betas are going to be identified off of deviations of whether this Chobani yogurt is advertised in every year in this market. Then it's going to drop out. It's going to be soaked up by the fixed effect. There's going to be time series variation in advertising within a market is going to help us to identify this beta. So in the figure here, we plot these impulse responses. So on the x-axis, we have this S, which is the number of years before or after the advertising. So year 0 is the year in which the advertising happens. This is 2 years before, this is 2 years after. And on the y-axis, we have the log response of quantity or prices. So you can see here that let's say we go from 0 advertising to advertising in a particular year, we get a 38 log point increase in quantity sold. So that's pretty big. We don't see any impact on prices, and this impact on quantity seems to be sort of concentrated around the year in which advertising happens. So we do observe a positive co-movement between quantities and advertising. Again, I'm not going to say that this is causal, but in the years where firms are advertising, we see greater sales. What's going on with stores and what's going on with sales per store around these episodes? You can see here that we have this kind of same spike, or a slightly smaller spike in sales per store, and then there's a more persistent effect on the number of stores, suggesting that firms are doing advertising at the same time that they're entering stores, and they're sticking around in those stores even after advertising. We also have evidence using the household panel that this is having a bigger impact on the number of customers, so the extensive margin of customers, and really not such a big impact on the sales per customer. Okay. So bottom line, we see an association in the data, a positive association in the data between quantities and advertising, and no association between prices and advertising, identified off of sort of time series variation within a market.
Doireann, is it right to interpret this more that advertising is an input to sales as opposed to an investment?
So this is from this spike here.
Yeah, it doesn't seem like it generates much. It depreciates very quickly.
So I'm going to defer that. We have some.
Okay.
This is still work in progress as to how best to estimate this, and do we want to think about this as investment, and do we want to estimate this in levels versus in differences?
Okay.
Okay.
Yeah,
Just
sure.
going to defer. That's something that we need to explore more.
Yeah.
May I ask a quick question, Doireann?
Yes.
And that, if the firm advertises for several years, then stops, is one only when she stops, and the zeros are for all the years in which it's advertising? How?
No, then it's going to be a 1 for all the years in which they advertise, and a 0 when they stop. And then the difference, suppose then they sell less in the year when they stop, that's going to help identify this positive relationship between advertising and sales.
So all the years in which she advertises is going to be on the 0 point.
So it's about deviation. So we can only identify here from, if you advertise in every year, then we can't identify this data. You got to be advertising in some years but not others in order to identify this.
Yes, I understand that. And I don't want to keep you too long. But the question is, let's say you advertise for 2 years, is the number 2 year going to be on the 1 or on the 0?
Sorry.
That goes into Georgia's question, whether it's depreciation or whether the firm just gave up on advertising because its sales were already falling. And as long as it was advertising it.
If it's okay, can I defer this question? I'm just having a hard time on the fly thinking about how that fits into the regression. Because
okay.
Yeah, with these leads and these lags, maybe we can talk about it later. Okay, so these are our facts. Entering firms grow by adding new markets, by building market share in continuing markets. They do so apparently by non-price means, and advertising seems to be at least one of those means that they're using to generate sales, potentially complementary with other non-price actions that they may be taking. So now we come to our structural model, which I'm going to talk about relatively briefly. So our goal in sort of why do we want a structural model? We want to sort of use these facts, these 3 facts, to help back out what is the contribution of variation in sort of intrinsic firm type to cross-sectional variation in firm size. And then, we haven't got to this yet, but we want to sort of back out what is the contribution of endogenous demand compared to the contribution of sort of exogenous factors to firm growth. To sort of achieve our goal number 1, and eventually as part of building up to number 2, we're going to build a parsimonious model which has predictions about the number of markets per firm, has predictions about market share and markups, And also, I didn't show you, but has predictions about exit patterns at the firm and the firm market level. And these are the moments that we're going to use to identify the model. And then we're going to use quantity and price impulse responses to advertising as non-targeted moments. So, instead of getting into the details of the model, let me sort of give you a broad overview. So a firm in our model is going to be basically an appeal type. What's appeal? Well, trade people talk about quality and sometimes they talk about appeal. Is your product something that everybody everywhere likes? Products, when I produce something that everybody everywhere likes, then my demand is going to be higher everywhere, conditional on my price. So that's the variation, sort of exogenous variation in firms that we're going to assume in this sort of version of the model. So a firm is this sort of appeal type. Then there are a range of markets out there. Firms face I like to think about a traffic light, which tells them whether or not they can enter a market and on what terms. So the sunk cost, which, if the traffic light is red, you don't get to enter a particular market. If the traffic light is orange, you have to pay a sunk cost to enter that market. And if the traffic light is green, you get to enter that market for free. Then in order to stay in that market, you also have a traffic light. So there may be a red light, which kicks you out of that market, at least temporarily. Doesn't matter how good you are. You may have an orange light, in which case you need to pay a cost in order to sell in that market. And a green light, you get to stay for free. Then within markets, firms can engage in actions like advertising to accumulate customers. It's going to be some customer base, which acts like a sort of a market-specific capital that the firm can accumulate by doing costly advertising. And there's going to be decreasing returns to this capital. So think about this as a sort of a dynamic Archilochus 2010 thing, where we've got these traffic lights to get to enter and stay in markets. And then we got this accumulation of market-specific capital within markets. So more precisely, this is basically the key equation of the firm's problem, which is the thing that we solve. So firm I in market K faces a demand which depends on the size of the market, and we allow that to be heterogeneous to match the fact that there are different market sizes across these different Nielsen DMAs in the data. There's going to be chi, which is an exogenous firm type. So good firms have high demand in all markets. Bad firms have low demand in all markets. Obviously, its demand depends on its own price. Here you'll see we're assuming monopolistic competition. We're talking about entrance. So we think that it's not, first order for us to engage with strategic concerns. These guys enter small and they do grow, but they're not enormous by the time we follow them for 4 years. So sort of assuming away strategic interactions seems fine to us. This D is their capital, where this capital or this customer capital, which has a decreasing returns. So alpha is less than 1. And there are some exogenous idiosyncratic demand, so that maybe I'm a firm with a low demand everywhere, but let's say it's a Minneapolis specific product and there are particular tastes in Minneapolis. I may have a high demand always in Minneapolis, and then we have an IID term where your demand may fluctuate over time within a market. So just highlighting in blue here the parameters that we estimate, but it's not going to be not necessary to pay too much attention to that in this overview of the model. Then this D acts just like a capital. You get to accumulate it. You get to accumulate it if you stick around in a market, and we assume that it fully depreciates if you exit. And this delta is just going to be the standard depreciation rate. And so you accumulate capital by doing here, we're going to call it A for advertising. You get some customer base free by entering a market. X here is an indicator for participation. And then, once you've been in a market, you get to accumulate customer base by doing expenditures on marketing and advertising, where we allow for some quadratic adjustment cost on those expenditures. So in this simple, I would say, prototype version of the model, we assume marginal cost is the same for all firms, and we're just going to focus on appeal differences or quality differences. And then here we have this traffic light for the sunk cost and a traffic light for the fixed cost, which are going to have an impact where, you know, good firms are going to want to enter all markets, both good markets and bad markets, both big markets and small markets. Whereas bad firms are only going to want to enter big markets and markets that are idiosyncratically good for them. And that's what these sunk and fixed costs are going to do. And they're also going to generate selection in terms of exit. We also have sort of a death shock, which can hit firms. The important thing to know about the solution is that we hardwired in that the prices were flat with respect to everything. So prices are basically the optimal price for the firm in this market constant because they have a constant marginal cost, and we have this CES demand with no sort of, my current demand doesn't depend on lag demand, so there's no sort of motivation for firms to muck around with markups to accumulate customers. So we solve this dynamic problem. We simulate a panel of data using this problem. We use the simulated panel to estimate the same regressions in the simulated data as we did in the actual data. And then we minimize the distance between the target moments in the data and the moments from the simulated data. So let me just show you briefly the fit of the current iteration. It's not perfect. We do a reasonably good job here. The dotted line is the data, the solid line is the model. We do a reasonably good job of matching sort of the target moments for quantity and price within a market, or with a market, sort of comparing across markets within a firm. We do a somewhat less good job of matching the evolution of the number of markets per firm, which is the thing that is going to pin down the distribution of firm types. But that's where we're at with that. Given this sort of setup, we used only these number of markets, quantity and price moments, and some exit moments to estimate the model. We can use the impulse responses of quantity and prices to advertising as non-targeted moments. And so on the left-hand side, you can see the impulse responses in the data for quantity and price, and on the right-hand side in the model. The magnitude of the quantity response in the model is twice that in the data. You know, again, we're working on that, but the sort of qualitatively, the picture sort of looks similar. Okay, so what do we want to? Why are we?
In the previous figure, can you throw it up again? Because you're pretty good. It's just you're kind of shifted down.
Yeah, so we have.
I mean, not exactly, but still, it's partly just a shift down in all those lower ones.
There's I would say too much variation in the model relative to the data.
In the initial.
In these initial.
Yeah. Okay.
Yeah.
I was thinking it looks like there's prospects for that to do better.
Yeah, we think that we can do better with this. This is sort of proof of concept at this point. Okay, so why do we want to have a model? Again, as I say, it is at this stage a little bit proof of concept, but you know, one of the things that we want to do with the model is back out what is the contribution of exogenous appeal to the cross-sectional variance of revenue. Okay, so this is an equation taken from the model, the revenue of firm I at date T. We can write that as a function of its appeal type, which in our current version is fixed, which is why we can't really say much about the contribution of appeal versus endogenous factors to growth, because we hardwired in there that appeal is fixed. And then we have, summing up over, all the markets, this is a choice variable for the firm. And then this is also a choice variable for the firm. And then, firms of different types are going to enter different types of markets. And then there's going to be a selection of, entering good versus bad markets that's going to be different for good firms and bad firms. So that leaves us with, sales revenue is equal to the appeal times some other component, which captures all of these different factors. And we can do a variance decomposition with this. And you can see here that on entry, the variance of the exogenous factor, the exogenous appeal, is basically 1/6 of the variance of revenue. And that share actually declines over time, but the covariance between appeal and this other term, which captures the endogenous demand component, goes up over time. So that the exogenous contribution to the cross-sectional variance in size of a cohort of firms goes down, while the sort of demand, the correlation between that and the endogenous demand part goes up over time. Okay, so just about on time. We I would say, we try to do two things in this paper. First of all, we show a series of facts about how entering firms grow. They grow by adding new markets. They grow by building market share in continuing markets, and they do this without changing their markups. And they use advertising, possibly among other non-price actions, to generate sales within markets. Then viewed through the lens of a model, the variance in firm size on entry is 6 times the variance in sort of the underlying heterogeneity in firm type, suggesting that demand frictions play an important role in magnifying cross-firm, sort of intrinsic cross-firm differences. And then, where one of the things that we want to use this model to do, or a generalization of this model to allow for time-varying firm type, is to decompose the contribution of decompose firm growth into a contribution of exogenous type and the sort of ongoing endogenous demand accumulation. So yeah, that's it.
Okay, great. Excuse me. So we'll just open the line up now. Anybody who has a question can just jump in, or if you want to raise your hand, that's fine too. We'll just go ahead and unmute yourself and ask away.
Doireann?
Yeah.
A couple of thoughts. One is the paper that we saw 2 weeks ago. It would be kind of interesting to compare. You have a different kind of model, but it's sort of going after the same thing. So it's
sorry.
That was the one by Joe.
Yeah, sorry, I was presenting simultaneously somewhere else.
But it did have this kind of dynamics, and I think his is more the natural generalization of the Archilochus one, but I mean, it's not saying it's right, but it was kind of nice the way it kind of gave a nice dynamic story for the Archilochus thing, and it seems like you're following that. And then the other thing I wanted to mention was there's a student actually of mine who's looking at the Nielsen, and I think the one thing that I think is different, but I'm not 100% sure, is he's kind of pushing this idea that a lot of the growth in the customer base, which he's also finding is where a lot of the action is through kind of word of mouth among customers. And I wasn't quite sure, but it seemed like maybe you didn't have that, in the sense that you had they only depreciated unless you did advertising, whereas maybe they kind of have a life of their own that they kind of spreads around. Like I went to State College, and then Jonathan had this nice yogurt, which I had to look up how to pronounce, the Fayet yogurt. So then I went and bought that here, and then so on. So, a lot of things happen that just without any advertising, just spreading the information around between the people like a contagion or something.
Right. I mean, that we'd be interested to see the paper of the student. I would say one thing, if firms, if lagged sales affect my current sales, if you think about the firm problem, that gives the firm an incentive to, reduce markups below the statically optimal level initially, in order to sell more initially, and therefore to spur more demand down the line. And we're just pointing out that we don't see that in prices. There's no evidence. Word of mouth could be important, but firms are not exploiting it to price dynamically and grab the customers that way.
What are competitors doing? So you showed about own brand advertising. Do you see is there coordination in advertising? Like during the summer, everyone is advertising for Chobani.
So we haven't looked at competitors yet, and that's definitely something that we can do. I think it's important that we're looking here at entering firms, which in general are going to be small, and we run the same sort of advertising regressions for incumbents. I didn't click on that button, but we don't see the same response of quantities to advertising for incumbents. It's a much flatter response. So I can show you if I go back to what we're doing on advertising here.
It would also be interesting to know on the if the entrants are small, if the incumbents just don't notice them, and so they don't. Because another thing you could do is you could advertise to preempt entry.
Yeah.
Or and if maybe they just don't notice them, but then by the time Danone realizes Chobani's on the market, it's too late. That's probably not a great example, but like that captures the essence of the mechanism.
Right. I mean, that's kind of the strategic. I mean, okay. So what we haven't looked at this strategic aspects. As I said, we are focusing on entrants. We have done this impulse response for incumbents versus entrants, and it looks pretty different. That's something we should look into more. We just took the view that for entrants, the strategic issue, at least for the impact of own advertising, is more likely to have an informative thing. And the pictures that we're seeing are consistent with that informative role of advertising. I do a burst of advertising at the same time as I'm entering stores so that people know my product is there, and I get a higher return from having paid the cost to place the product in the store. So this is, I say, not conclusive evidence that this is about information, though that is how we think about it, but we should dig more into that.
My question really it goes along the lines as Jeff's about competition, because one with Chobani, you don't have just a product, you had a whole new product category. They really introduced the idea of Greek yogurt. If you take the example, say, of Stroh's beer, which they marketed as a firebrewed beer, their market expansion geographically was rather similar to the charts that you showed. However, the result was a failure and not a success in time. I'm also wondering how you address the idea of a product, not just as a tangible thing, but as a consumer experience, such as a consumer buying a Nikon camera, not to have a camera, but for what it means for their own self-fulfillment and expression as an experience. But again, mostly I am curious how your model addresses the competitive reaction to competitors either already in the market or who will respond in that market.
No, the point you bring up about the new products, I mean, that's pretty interesting. My co-authors have worked on a lot on new products, and something that we can look at is, does this look different for products that have more novelty versus products that have less novelty?
It sure looks different to your distributor when you're trying to get into a chain and win the battle for market space. If you are saying, this is a whole new product category, this is not just yogurt, this is Greek yogurt, it has twice the protein of other yogurts, and no one else had that. When you have a whole new product category, it shows dollar signs to your distributors.
No, that's definitely something that
after all, they are not yet directly selling that product to the consumer.
So Doireann, I think I even asked Joe the same question. Your model implies some kind of hierarchy as to what markets you enter in what order. Mm-hmm. Do you do anything with that as far as in the data, either as a, oh, okay, it was here and I just missed it.
No, I didn't show it.
Okay.
I wanted to get to
know you showed us
all my facts, my facts, not just some of, sorry, back.
Yeah, because you showed us the map and kind of you start on the East Coast and move westward or something, but.
Okay, so we can decompose total sales at the firm level into the number of markets and then the average sales per market. So we run the same regression for average sales per market as we run for number of markets. And then average sales per market, okay, we can't run this decomposition because there's a covariance term, but it also, average sales per market is made up of average market shares and average market sizes. And there turns out to be a negative covariance between these two things. But we calculate all of these things and run the same regressions. And you can see here that, the bad firms on average are entering better markets than the good firms. The good firms, so this is the red line, there's the guy who stick around for 5 or more years. Basically, on average, the size of the market that the average market size is not changing much over time. But the bad guys, the ones who eventually exit first the little markets, and then they exit the big markets later. There was less of a hierarchy of markets showing up here than I anticipated would show up, but there is this tendency to see a negative association between firm type and market type. So the good firms enter all the markets, and the bad firms only enter the good markets.
Okay, interesting.
So just to follow up on that, Doireann, I keep thinking about Tom Holmes's Walmart, and your firms don't have a home. And I think you did it exactly right. You've built a beautiful parsimonious model, but I think having built it, there are some things you could kick the tires on. And one would be if there is a kind of home starter market effect, and whether firms tend to expand geographically, which your model says they don't. And maybe for food, that's a good approximation. And also, it seems you're looking at markets entry independently across the markets. And going back to what I asked you about before, it would be interesting to see if later markets have different dynamics from earlier markets.
Right. Again, that's totally something that we can look at.
Yeah, Jeff Thurk is the expert on this stuff, but if you look at like craft beer, that has a very geographic kind of Walmart-like spread of distribution. There's beers that you start off at Madison, and then maybe you sell to Wisconsin, and if you're lucky, you get to Chicago, and then maybe you jump to the coasts. But I get that's a different sort of good. Then there's kind of complications there.
But that could also be a kind of word of mouth story, is the geographics concentration and spreading from a single spot.
So two thoughts here. So one thought is, I said there's other work on exporters where you see very similar patterns, where we do know there's we know where they're starting. And one fact that came out from that work is the good guys, they start exporting right away. I mean, it's like you're really unlikely to be a firm bopping along, selling to the home market, and then suddenly you get a shock and you figure you're much better than you used to be, and you start exporting. That basically, if you don't start exporting in your first 2 years of life, you're never going to export. So that's something that I haven't looked at that here, but we can totally look at. On the later markets versus the earlier markets, that's something that we should totally do. We looked at initial products versus subsequent products, and you do see, I think, a slightly steeper growth trajectory for the subsequent products than for the initial products, and I would expect potentially to see something like that at the market level.
So let me follow up on, does the GS1 data that has the does that have the location of where, maybe it's like the headquarters, but it doesn't have where it's produced?
So David, I saw he was here, I don't know if Sarah's here, they definitely know more about this.
Yeah, so GS1 as the headquarters location, and then we have matched these firms to a net where we can get different plants, so where we can know all of their locations. We haven't used that, but we have that machinery.
I was wondering if you could talk about the role of partnership with retail stores. So you could imagine that signing up a contract with Whole Foods or with Walmart would be a pretty big way to increase your customer share. And so I wonder how much does that explain this growth within market? And I was wondering, maybe there are also interesting interactions with advertising where at the same time you sign with a new retail store and it's a good moment to start advertising. And so there might be kind of, that might say something about what advertising is getting at.
That gets at a really important point. I mean, we sort of have thought of, is the media market the right unit here? You enter markets by entering chains that have stores in a market. And so is, from the point of view of the manufacturer, is the chain the market, or is the regional location the market? It turns out that just because you enter a chain doesn't mean you end up selling in all the stores in that chain. We are happy to continue with our media markets, which also help with the matchup with advertising. As regards the complementarity between advertising and number of stores, I showed this briefly, but I can bring it up again. We do think there is a complementarity here in that the impulse, this is the impulse responses of number of stores to advertising and sales per store to advertising. And so we think that these are complementary actions that the firm is taking. I decide to enter a market. I do that by selling to chains that sell in that market, and I add stores at the same time as I'm doing a burst of advertising. We also, I didn't show that either, but whoops, sorry. Go back here. We also look at the number of stores and sales per store within a market. So both margins are active. The sort of the kick that the firm is getting from sales per store is somewhat bigger overall, but it's sort of a more long drawn out impact sort of response in terms of number of stores.
I wonder if you think about the geographic, because this is these are going to be driven by distributors. Distributors have large geographic reach. If you're going to see I'm a small firm, I get in the portfolio, the catalog of a distributor who covers the East Coast, and bam, now I'm everywhere in the East Coast. But so it might be useful to just go and pick a very Chobani is not going to be a great example here, but a small, and then actually go and line it up with the distributors.
Right. So that's a good point. Haven't we look at chains but not distributors? Here, I will say that we did look at, if I place a brand in a chain, do I place it in all the stores that chain has? And no, you don't. So here, let's think about the first year that I place a brand in a chain, and I think about the number of stores, a number of DMAs where the chain has stores, number of markets where the chain has stores. I'm not getting into all of those markets. Sort of for the biggest chains, I'm only getting to 15% of those markets by placing my brand in that store. So chains matter, and then of course for smaller chains, distributors matter, but that's not everything that's going on. There's also some regional component which is sort of going on at the sub chain level.
Another possible consumer product you might look at, and I'm sure you can get historical data on, was the experience of a brand called Jolt Cola, a beverage. And Jolt decided to, because of the competition they anticipated from Coca-Cola, they made the Southeastern market or region their final place to enter as they went around the country geographically, region by region. And possibly data on that experience might be useful to you.
Sure. We can take a look at that.
Okay, so this seems like a good spot to stop the recording and call this the official end of the seminar, and thank everybody for showing up. If you'd like to stick around and talk some more, we can leave the stream open. Otherwise, let's see, I'm supposed to have the calendar open before I do this stuff. Otherwise, we have no seminar next week because it'll be Thanksgiving Day. So everyone enjoy the week off, and we'll see you in in 2 weeks, where Ricardo Reyes Heroles will be presenting. Thanks.